Are you wondering what's better, buying stocks or investing in ETFs and index funds? In this video, I'll break it all down in simple terms so you can understand how Americans are building wealth through these investments in 2025. By the end, you'll know exactly which option fits you best, whether you're just starting out or already on your investing journey. Let's start with stocks. When you buy a stock, you're purchasing a small piece of ownership in a company. For example, if you buy shares of Tesla or Apple, you literally own a part of that company. When the company performs well, the value of your stock rises. Many investors also earn dividends, which are small profit payments made to shareholders. The exciting part about stocks is their potential for fast growth. But that also comes with risk. Prices move daily, and a sudden drop in the market can reduce your portfolio value quickly. That's why for beginners, picking the right stock can be confusing and sometimes stressful. This is where ETFs and index funds come into play. Think of them as baskets full of different stocks. Instead of putting all your money into one company, you invest in hundreds at once. For example, the S&P 500 Index Fund includes 500 of America's biggest companies like Apple, Amazon, Microsoft, and Google. When you buy into that fund, you automatically own small portions of all those companies. This strategy, called diversification, helps reduce risk. So even if one company performs poorly, others in the fund can balance out your returns. Let's make it even clearer with an example. If you invest $100 in Tesla and the company's stock crashes, you lose money fast. But if you invest $100 in an ETF that includes Tesla, Apple, and hundreds of others, your risk is spread across all of them. That's the beauty of ETFs. They provide balance and stability, especially for new investors who don't want to monitor the market every day. Now you might be thinking, what's the difference between an ETF and an index fund? Both track major market indexes like the S&P 500, but the way they work is slightly different. ETFs trade on the stock market just like individual stocks, meaning you can buy or sell them anytime during the day. Index funds, on the other hand, are managed by investment companies and are priced only once a day. ETFs often come with lower fees and offer more flexibility, while index funds are great for long-term automatic investing. So, which one should you choose? If you enjoy researching companies and want full control, investing in individual stocks might be your style. But if you prefer a simple, lower-risk approach that grows steadily over time, ETFs and index funds are a smarter choice. Even Warren Buffett, one of the world's greatest investors, has said that most people should just buy low-cost index funds and hold them for the long term. The next question is, how to get started? The good news is, you don't need thousands of dollars to begin investing. Today, platforms like Vanguard, Fidelity, Robinhood, and Charles Schwab allow you to start with just a few dollars. Many even offer fractional shares, which means you can invest in big companies like Apple or Amazon without buying a full share. The key is consistency. Invest regularly, even if it's only $50 or $100 per month. This strategy, known as dollar cost averaging, helps you build wealth by investing through both market highs and lows. Another important tip is to reinvest your dividends. When companies pay you dividends, don't withdraw them. Reinvest that money back into your portfolio. Over time, this small habit creates compound growth, where your earnings start generating their own earnings. It's one of the most powerful wealth-building tools available to investors. Before you invest, take a moment to define your goals. Are you saving for retirement, buying a home, or just trying to grow your money long-term? Your goals determine how much risk you can handle. If you have a long time before you need the money, you can afford to take on more risk with stocks or ETFs. But if you need your money soon, consider safer investments. Here's another key concept: expense ratios. Every ETF or index fund charges a small management fee, called an expense ratio. Always check this before investing. A lower expense ratio means you keep more of your profits over time. Funds from Vanguard and Fidelity are known for being among the cheapest and most beginner-friendly options in the U.S. market. You should also understand market volatility. It's completely normal for markets to rise and fall. The mistake many beginners make is panicking during downturns. Smart investors see those dips as opportunities to buy more shares at lower prices. Over time, markets have always recovered, and staying consistent through ups and downs is what separates successful investors from emotional ones. Another great benefit of ETFs and index funds is automatic diversification across industries. You might not know which company or sector will perform best in the future: technology, healthcare, or finance. But when you invest in a broad index like the S&P 500, you automatically spread your money across all major industries. This balance helps your portfolio stay strong even when certain sectors slow down. It's also helpful to learn about tax-efficient investing. ETFs are generally more tax-efficient than mutual funds because they trade less often. Fewer trades mean fewer taxable events. If you're investing through retirement accounts like a 401k or Roth IRA, your taxes are even lower, or in some cases, completely deferred until withdrawal. Understanding this can save you thousands of dollars in the long run. Finally, let's talk about time in the market versus timing the market. Many beginners try to predict the best time to buy or sell, but the truth is, no one can consistently do that. Instead of waiting for the perfect moment, focus on staying invested. The longer your money stays in the market, the more time it has to grow through compounding. That's why consistency and patience always outperform quick decisions. To sum it up, stocks can bring higher rewards, but also come with higher risks. ETFs and index funds offer stability, diversification, and long-term growth. The smartest move is to start now, invest consistently, and think long-term. Remember, wealth isn't built overnight. It grows slowly through patience and discipline. If you found this helpful, don't forget to like this video, subscribe to the channel, and share it with friends or family who want to learn how to invest smartly in 2025. In the next video, I'll show you how to build a balanced investment portfolio that actually works for you. So stay tuned and keep investing wisely.